You think you're walking into a coffee shop. You think you're handing over $5 for a pumpkin spice latte or a cold brew. You are wrong. You are walking into an unregulated financial institution. You are depositing hard currency into a vault that doesn't look like a bank, doesn't act like a bank, but holds more cash than actual banks. Starbucks is not a coffee company. Starbucks is a fintech giant that uses caffeine as a loss leader to manage a multi-billion-dollar hedge fund. Look at the numbers. They are holding between $1.6 and $2 billion in stored value card liabilities. That is cash sitting on gift cards and mobile apps that has not been spent yet. That is a deposit. To put that into perspective, 85% of U.S. banks have less than $1 billion in total assets. This corporation has nearly double that amount just sitting in its mobile app ecosystem. But unlike a bank, they do not have to follow the rules. When you deposit money into a savings account, the bank pays you interest. When you load $20 onto your Starbucks app, you are giving a massive corporation a 0% interest loan. They take your cash today, they give you a product months later. In the meantime, they can use that capital to open new stores, buy back stock, or invest in supply chains. You are funding their expansion and you aren't even getting a free refill for your trouble. The global economy is built on debt, but usually the person borrowing the money pays for the privilege. Here, you are paying them to hold your money. And it gets worse. This isn't just about interest rates. This is about a phenomenon the industry calls breakage. It sounds like a dropped mug, but it is actually free revenue. Breakage is the money left on gift cards that is never spent. It's the $2.14 stranded on an old plastic card in your junk drawer. It's the 70 cents left on your app that you forget about. To you, that is loose change. To this company, it is a gold mine. In a single year, they recognize nearly $200 million in breakage revenue. That is $200 million of pure profit exchanged for absolutely zero goods or services. It is free money. Imagine if a bank just decided to keep the last $5 in your checking account because you hadn't touched it in a while. There would be riots. Here, we just call it a loyalty program. The casino chip economy. Let's dissect how they pull this off. It is the same psychological trick used by casinos in Las Vegas. When you walk into a casino, the first thing you do is exchange your real money. Money that pays rent and buys groceries for plastic chips. Once your money is converted into colorful plastic discs, it stops feeling like money. It becomes play money. The psychological pain of spending disappears. You bet more. You tip more. You lose track of value. The Starbucks app is a digital casino. You convert your currency into stars and digital balances. This removes the friction of the transaction. Swiping a credit card feels like spending. Scanning a QR code feels like a game. And this game is rigged to ensure the house always wins. By bundling your transactions, loading $25 at once, instead of buying 5 coffees separately, they bypass the credit card interchange fees that eat into retailer profits. Every time you swipe a Visa or MasterCard at a local shop, the merchant pays a fee of around 2 to 3%. By getting you to load a lump sum onto their proprietary payment rail, this coffee giant pays that fee once, not 5 times. They save millions in transaction costs, while you lock up your liquidity in a currency that can only be spent on muffins and macchiatos. Most people look at the app and see convenience. A surplus mindset sees a trap. You are voluntarily restricting your own capital. Cash is king because it is liquid. It can be used anywhere for anything. When you convert cash into a stored value card, you are freezing your asset. You are turning liquid gold into a frozen block of ice that can only be melted down inside one specific store. They have effectively printed their own currency, and unlike the US dollar, which is backed by the full faith and credit of the government, For whatever that is worth these days, this currency is backed by nothing but the promise of future caffeine. And this is where the regulators get confused. If it looks like a bank, holds money like a bank, and lends money like a bank, surely it must be regulated like a bank. Wrong. Because they don't offer cash withdrawals, they dodge the heavy compliance costs that crush traditional financial institutions. They don't need FDIC insurance. They don't need to maintain specific capital ratios for lending. They exist in a regulatory gray zone that allows them to operate with the agility of a tech startup and the capital reserves of a sovereign nation. But don't just take my word for it. Here is the breakdown of the hidden numbers. The personal pivot, you are the product. Now, why does this matter to you? That you might say, it's just coffee, relax. But that is exactly what they want you to think. This is about your surplus. This is about your financial sovereignty. When you participate in these ecosystems without understanding the mechanics, you are leaking value. You are the product. Your spending habits, your location data, your frequency of purchase, that data is being harvested to refine the algorithm that gets you to spend even more. The gamification of your wallet is the ultimate enemy of growing a surplus. They use stars and rewards to trigger dopamine hits. Buy one more and get a free pastry. Double star day. These aren't gifts. They are behavioral modification tools designed to extract capital from your pocket and move it onto their balance sheet before you even need the product. Every dollar you lock up in an app is a dollar that isn't working for you. It isn't in a high-yield savings account earning 5%. It isn't in the stock market compounding. It is sitting dead in a corporate account earning interest for a CEO you will never meet. You are losing the inflation game twice. First, because inflation devalues your cash. Second, because you have converted that cash into a store credit that has zero purchasing power outside of that specific ecosystem. If the price of a latte goes up, and it always does, your stored value buys you less. You are holding a depreciating asset in a closed-loop economy. This is the antithesis of building wealth. Wealth is about optionality. It is about having resources that can be deployed where opportunity strikes. By prepaying for coffee 3 months in advance, you are destroying your optionality. You are telling the market, I commit this capital to sugar and water, regardless of what happens in my life or the economy. The solution: be your own bank. So, how do you stop the bleeding? How do you take back control of your capital and stop acting as a creditor to billion-dollar conglomerates? You need to become your own bank. Here is the 3-step protocol to exit the casino and start building real surplus. Step 1 is the zero balance rule. Never leave money sitting in a merchant app. If you must use the app for the convenience of ordering ahead, load exactly what you need at the moment of purchase. Do not auto-reload. Auto-reload is a vampire on your bank account. It is designed to make you forget that money is leaving your possession. Turn it off. Force yourself to feel the friction of every transaction. When you feel the payment, you spend less. Step 2 is the interchange arbitrage. Use a credit card that pays you points, not the retailer's app. When you load money onto a merchant card, you get stars, which are a fiat currency with an undefined value controlled by the merchant. When you use a solid cashback or travel rewards credit card, you are earning a currency that has broader utility. You want to be on the side of the transaction that earns the interchange fee, or at least gets a kickback from it. Don't let the retailer pocket the savings. You keep the rewards. Step 3 is the opportunity cost audit. Look at every subscription, every wallet balance, and every gift card you own. Tally it up. That is your dead capital. If you have $500 spread across Amazon, Starbucks, and Chick-fil-A apps, that is $500 that could be buying a fraction of a share of an index fund. It sounds small, but wealth is built in the margins. It is built by plugging the leaks that everyone else ignores. The reason these companies are profitable is that millions of people ignore the pennies. They ignore the breakage. They ignore the float. You are not millions of people, you are a surplus builder. You understand that money has a time value? Every day your money sits in their account, they win and you lose. The financial system is evolving. The lines between a tech company, a coffee shop, and a bank are blurring. If you aren't paying attention, you will end up as a source of cheap liquidity for the Fortune 500. Don't be a source of liquidity. Be a fortress of capital. Keep your money in your control until the exact second you exchange it for value. That is how you win. That is how you grow a surplus. If you found value in this breakdown, subscribe and turn on notifications.